No, I'm not at all schadenfreude. I think, I've devoted 7 years of my life to the euro as a project, and I think the euro is a good project, but like with every good project, the proof of the pudding is in the eating. And so I never thought that negative interest rates are such a great idea. They have very pronounced side effects which come to bear over time. And you can see it in any bank's net interest income. In the first and second year, that goes down a bit because you have 1 or 2 years of contracts that run out and need to be renegotiated at a new level. With the recent ECB move, anybody in Europe has lost the hope that for the next years to come, we will see a different interest rate environment. So the new 5-year plans, the new 3-year plans, or even the 1-year plans of banks will look totally different. We're becoming more like the Japanese environment, where any hope that the environment will improve and fix it for you is going. So banks need to focus on the levers that they can move in order to be profitable, rather than rely on a rebound of markets or on a better economy. And that, for me, is really the downside of this policy. It creates a long-term disincentive for really investing in fixed income and for investing in the European economy, because you just don't get rewarded for any risk you take with such investments. You look at the US, interest rates are at a different level, and so it's very, very different to invest in the US. They have a deep capital market, and the way Europe is going, it's losing the biggest capital market with Brexit. It hasn't developed broad-based capital markets on its own, which leaves Asia and the US as the real alternatives for European investors. And that's putting Europe third in a global economy in terms of dynamics. So there's no schadenfreude whatsoever. I think the European project is suffering from severe setbacks. I think you can see with Britain leaving, that is a vote of really not seeing what the future of a country is that isn't in the Euro project, because Europe has become very Eurocentric in all the governance reforms they do. And instead of creating an open and dynamic European capital market, they're raising the barriers to the European capital market to the outside, like the recent decision to Switzerland. And at the same time, they think it's enough to eliminate internal barriers of capital flow. But I tell you, Europe will not recover by just rerouting the bit of capital that Europe has within the European borders. Europe needs to attract Asian investments and US investments to grow. And if that market is not open, and if that market doesn't reward investments there, they're going to have a hard time. So I'm a bit disappointed that the project has become an inward-looking project rather than making Europe a global financial center, which is attractive and open to the rest of the world. And being here at the IMF meetings, you can see we're losing a bit the globalization that we've had in almost every dimension. Trade's on a reset, financial markets are less global, banks get more fragmented by regulation. So the European project, I think, is not at risk, but it's definitely not going to go forward in the next few years, because everyone's trying to lock in the current degree of integration they've achieved, but nobody has any visions how Europe can evolve forward. And there is some, I think, disintegration around the edges of Europe. Britain is one example.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.